I'm Charles Payne, and welcome to Making Money Right Here, Right Now. That's exactly what we're going to do. We're going to help you make money in the stock market. It's about investing and managing your portfolio. Here to help, our investment pros, Heather Pabaka. You get scuffed up pretty good today?
Oh, my gosh. What? I mean, that was just dismal. But how are you so happy with all this going on?
When you see a dress that you like and it costs $200, and then a week later it's $150.
I hear you.
Okay.
Now you're speaking my language.
Joni Courtney, the employment expert. You have a lot of questions for you today.
We have lots to talk about. Jobs, jobs, jobs. So
I hope it is jobs, jobs, jobs.
I hope so, too.
Ain't afraid of jobs. Okay,
I'm optimistic.
Matt McCall, you wore Red Sox. I guess you knew something was up.
You know what? I don't wear red because I'm superstitious. I always think the market's going to go down, but I figured we're down 300 points. I might as well throw them on tonight.
Kate Rogers, a lot of stuff on social media today. People just don't know how to read this. The overarching theme about the Fed, there's a whole lot of narratives here. We're going to cover them all.
Absolutely. And everyone, of course, is anticipating the jobs report tomorrow. Good thing we have Joni here. Good
thing we do. Hey, and of course, today we've got a special guest for you. Jim Frischling, he's president of NewOak Capital. Jim, I got a lot for you today, my man. I'm going to put some pressure on you about your boys, the hedge fund guys. I'm a little bit confused about, what's going on there. You got to clear this up for us. Hey, guys, now remember, one thing I'll clear up for you right now. I've said it before. I'll say it again. We want to make you a lot of money. It's not about day trading. It's not about countdown to the crash, although it felt like it today. Here's the real deal. Long-term successful investing, you develop and you manage a portfolio, and over time, you should get rich. And now, how do we do that? Well, we look behind the scenes at what we call the real deal. We open the hood. We get down in there. We get our fingernails dirty. But that's how we make you more money. Let's do that. Let's dig into the first real deal. Now, yesterday, it was interesting because I saw that consumption number. We had the GDP numbers out. Saw that consumption was up and also that savings were increasing at the same time. For me, it had to mean that either wages were increasing or that people were using credit. To Heath's point, now there's been evidence that people are using credit, but then this morning, well, we saw evidence that maybe people are actually earning more money. Now, the biggest spike in compensation since the first quarter of 2008 could mean that the moment of truth is going to be here sooner rather than later. And of course, I'm talking about the Fed raising interest rates. And while most mature market investors know it's better for an economic rival to lead this rally, there will be a period of angst no matter what. Compensation, according to the ECI report, spiked 0.7%, as that was the average for civilian workers. Listen, generally this is all good news, and for the most part, it's not surprising. Signs have pointed to higher wages, but I think the spike, the pace of it, did spook investors. Now, on that topic, by the way, spooking investors, this situation in Russia, that gets weightier every single day, and I think it was just as big a culprit of today's sell-off as anything else. Jim, I want to start with you. I want to ask you, do you think it was Russia? Do you think it was I didn't even mention Argentina in the intro, higher wages, or just a dull summer day that got out of hand?
Can I take E and actually reference all of the above? I think all of those things did contribute to the sell-off. I'll also say that, when the rally was in full fervor, bad news for the economy meant good news for the markets because it meant the Fed would stand pat. So now I think we're seeing some good news for the economy, a good GDP number, again, wages going up. We're expecting some good employment tomorrow, and I think people are seeing that the Fed is going to have to take its foot off the gas.
I would argue that since the Fed said that we were going to lower QE in December of last year, I felt like good news was good news and bad news was bad news. We've had a lot of jobs reports that came in over 200,000. Wages aren't beating inflation. They started to edge up. It just felt like today a little bit of much ado, not about nothing, but overreactions to me.
I personally think it's death by a million paper cuts. I mean, we have so many little stories out there.
That was one big piece of paper.
Yeah, there's a lot of stories out there. I mean, we could throw in the fact that Chicago PMI had its biggest drop since 2008. We could throw in the bank in Portugal that fell 49% overnight.
How come no one threw that in, though? That's what I'm saying. Today was not, to Jim's point, today the narrative if you turn on TV, if you listen to people talking, it was all about how great things were. When Ryland, one of my stocks, got clobbered, the housing market's looking terrible. Chicago PMI, manufacturing number, got destroyed. No one talked about these things. Initial jobless claims came back up, but the narrative is how great it's becoming.
Well, because I think that's been a narrative recently, because the stock market's been doing better. And what sells? I mean, the Chicago PMI is not sexy to talk about. We can sit here and talk about it, but nobody cares about the Chicago PMI.
I don't think it's that great. We're talking about the ECI being really good, 0.7%. That's a quarterly estimate. If you look at it annually, it's 2% up. That's nowhere near where we were before in 2006.
It was 4% before the recession.
It was 4% before the recession.
Right. A great point. I was going to bring that up. In a regular, healthy economy, 3 to to 4% is where you would be. And by the way, I don't think 2% is enough to make the Federal Reserve change what they're looking
We're
at.
celebrating mediocrity here.
We keep saying this is the economy that's slowly.
Well, today we didn't
chugging
celebrate
along.
mediocrity.
Well, yeah, today I felt really bad. But this is slowly chugging along, and it's been a long time coming. I'm with Heath. I don't think this 0.7% uptick is going to push Janet Yellen to raise these rates anytime sooner.
Yeah, and you know, wages, it's really been the missing link here, right? It's been the missing piece. But if you listen to what Janet Yellen said, she talked about we still have a lot of people unemployed,
Right.
a lot of people that are underemployed, a lot of people on temporary jobs, and a lot of people that are just, you know, not finding jobs that they can live up to their potential and
Right.
have opportunities
She
to
knows
make
that
more
that's
money.
6.1%.
So they're still concerned about the labor participation
And they
rate.
should be. They should,
Yes.
because that 6.1% unemployment rate is completely deceiving. All right, guys, got to stop right here. Let's blow the whistle. Open a page from Payne's Investment Playbook. Let's talk about these hedge funds again. I'm calling it hedge fund Armageddon, okay? We've seen this already with these hedge funds, particularly these superstar managers. They've gone after individual stocks. Well, now the activist investors, at least one of them, has pushed a nation into default. It's a battle of wills that sees one of the most successful hedge funds in the world against one of the planet's bigger economies. The hedge fund, believe it or not, is winning. Here's your combatants. You've got Elliott Management versus Argentina, Paul Singer, Christina Kretzner. Those are your leaders. He's got $24 billion on the assets. They got $484 billion a year GDP. 3,000 people versus 41 million people, and these guys are winning. But hedge funds in general have not been winners. In fact, they haven't been winners in a long time. The last time their industry average beat the street was in 2008. So maybe that's why these guys are always looking for the edge, always trying to bully their way to riches through activism. Now, I got to tell you, for the so-called activist hedge fund managers, their high profile, in my opinion, helps their performance, and that's helped them get to their riches. Take a look at this last year. George Soros, $4 billion. David Tepper, $3.5 billion. Stevie Cohen, $2.3 billion. By the way, he's back in the game. He's already made $1 billion this year. John Paulson, $1.9 billion, and of course, Carl Icahn, the man in the moment, $1.7 billion. Guys, let's talk about these activist hedge fund guys. And Jim, we brought you here. You know, usually we do the hot seat at the end of the show. We're going to do the hot seat now because you help hedge funds. Why has their performance been so appallingly disappointing?
Oh, wow. I mean, first of all, on the activist side, they're actually beaten right now. The hedge funds are almost 2x beating the typical, I guess, standard hedge fund. In terms of, we're at all-time highs of the equity markets. A lot of things have been picked over. This is a difficult time to make money, and the reason why I think we're seeing...
They haven't made money on average since 2008. They haven't beat the street.
Look, I know investors that actually are down on the hedge fund model because they don't want guys to know their yearly take on January 1st. They want guys to earn it throughout. So to a certain extent, we know investors who look at these guys less as a hedge fund model and more as an operating company to invest in a strategy that they believe is going to work. And the activists are trying to add alpha. And look, the capital.
What does that mean? Because let's just slow down a little bit. I want to go talk to the audience. These hedge fund guys, generally they get a 2% of your money just to run day-to-day operations, and then they'll take 20% of profits. That is pretty hefty for people who are underperforming. Now, what does alpha mean?
Alpha means they want to beat doing something extra to enhance the performance.
To justify the exorbitant amount of money that they demand from
Correct.
people.
We haven't seen as many activist hedge funds launched since 07. And 07, you know, the hedge funds we dealt with were taking active roles in the housing market and actually contrarian roles in the housing market. So there is an argument to be made that sometimes these guys are trying to keep everybody honest. You know, if everyone's on one side of a trade, you might find yourself on the wrong side of the trade.
Now you're doing the double speak thing. I don't know, Jim. Listen, I love you, man, but I still don't get it. I still don't get how these guys people keep giving them billions of dollars. I don't know. They get them from states. They get them from rich people. And you could have just bought an index fund and crushed them.
Yeah, but it's that perception that this person made $4 billion last year, that they must know something that I don't know or you don't know. So people are willing to pay for that potential. It's risk versus reward. They know we're taking a little bit of risk, but they think the reward potential is so high that they'll give up 2 and 20 to get that potential reward.
I mean, think about it. How much of the money is going to the investors? 98%, 80% of the profits above a certain threshold go to the investors. That's not a bad deal, okay? it's not a
terrible deal.
Only
Really?
someone in the hedge fund manager.
I will tell you, the hedge funds we work with, for the most part, they're doing a lot of work. They're playing aggressively.
Okay.
And they're
we have people who are watching this, and they pick out their mutual funds, and they don't want to pay a manager more than 1% to manage their mutual funds. They want 99% of those profits. So, I mean, I guess it is a different world, but it's one of these things where, and I also think the activists now have played the media to the point where they can go on TV and say, I'm long this, and it automatically goes up, or I'm short this, and it automatically goes down.
It's a perfect environment for them. We're in a 24/7 news environment. They've got social media and many channels to get their message out. We're also in an environment now where I have to say, when I started my career, litigious strategies or litigation as a strategy, I did not find was as in vogue as it is right now.
But if they're in a perfect environment, why are they struggling? Why have they struggled for the last 6 years? That's the thing. And you say they're doing a lot of hard work. I'm not doubting they're doing a lot of hard work, but if you're going to be taking 20% of profits, you better be doing a lot of hard work and showing performance at the same time.
And Heatha, before we switch topics, you sell research to some of these guys too, don't you?
I do, and I can't necessarily talk about my clients, but what I wanted to say was that, to your point, people like Eddie Lamper go on, take the stage, as media people, we cover this, and this really has a major impact on the stock. Sears, for example, we saw the same thing happen with Ackman. We saw the same thing happen with, a bunch of these hedge fund managers. So it really has a massive effect, just not on the manager level, but the individual level.
I guess the real deal, Jim, is I'm just jealous. Don't worry about it. All right, guys, coming up today's stock suggestion. All right, guys, let's get down and help make you some money. Back with us for the idea today is Jim Frischling. And Jim, I can't wait to hear what you have to say about this particular investment idea. I'm going to mention, I've mentioned it before in the show. It's up a little bit, but I think it really still has room to break out. It's in the semiconductor space. It's called Broadcom. Now, recently they made a decision to sell the cellular baseband business. I think that was fantastic. Now it's really more of a pure play on wireless infrastructure and connectivity. Its chips are going to be focused on applications, Bluetooth, cable, embedded processing, consumer electronics, also the Ethernet customers, Amazon, Apple, Cisco, Dell, you name it. Now, in the most recent period that they reported, growth margins expanded 55.2 from 52.2. I love when that expands. The net also increased by almost 28%. Both of these areas, though, I think are going to start to ramp up much higher. Now, technically, there's huge resistance between here and $40, but once this bad boy breaks out, there's huge potential to the upside. My target is 47, and I think I'm being conservative. Jim, what do you think about this one?
We're on the same page with you. We actually we like the fact that they're getting rid of something that was a kind of a very competitive space, and they weren't a dominant player, and instead they're going to focus on broadband, on connectivity, on infrastructure. We think about what they do in set-top boxes and how they're as people move to Ultra HD, and as the emerging markets have more demand for boxes, we see great growth there at 10% annually. We also think in the smartphone and tablet space, and we like mobility as you do. We think these guys continue to come up with the cutting edge components to that sector, and we're bullish on it.
Would you pay millions of dollars to teach people to lose a Southern accent?
Oh, Southern accents. I mean,
you got a great accent. Where are you from originally?
Which accent do you want me to put on? I'm from 83rd and 3rd Street. Up here in New York City.
I got you, baby. What do you think, Matt?
I wouldn't buy it here. I like everything that you said, like everything that Jim said as well. Valuations are fantastic, but it's hit its head against that 39 level about 5 times since 2012. So buying here, you're kind of capped. I want to see it close above 39 for a couple of days. If that, it runs right to 47.
I'm going to go to you 1 second, Heatha, but I'm glad Matt brought this up for the audience. A lot of technicians would rather pay up for a stock and know that it's breaking out, know that it has momentum, rather than bumping up and pulling back down. A lot of people don't get the concept because, it's always buy low, sell high, so I know exactly what you're talking about.
I'm not buying this whole fundamental discussion here. Okay, so first of all, Broadcom is getting rid of 240 jobs in their Irving office. Overall, they're going to eliminate 2,500 positions. That's going to save them $700 million. How much of this fundamental growth is engineered?
Well, $700 million in the grand scheme of things isn't going to be great, but here's the thing. Listen, they're getting rid of a couple of businesses, to Jim's point and the point that I made, and they're focusing on where they're going to be competitive, where they can take market share, where they can have some pricing power. I just think it's a brilliant move.
Growth has nothing to do with job cuts. That's expenses. Growth is still there.
And I looked at just even where their jobs are open right now. And it's interesting. They have a lot of openings for engineers in India. So, I mean, they definitely, though they might be cutting jobs in Irvine, California, they certainly are adding jobs in other places.
All right, guys, now let's talk about this. You knew we had to talk about it. We saved it for last, this wild ride. Now, tomorrow we get the one report that I think everybody on Main Street and Wall Street, we're all going to be watching it together, and that's the jobs report. This is for July, of course. Joni, you were bullish earlier in the week. You talked about looking for 250,000 jobs. A lot of weird, inconsistent data since then. How are you feeling about the number, and are you as positive as you were earlier in the week?
Yeah, you know, I'm still optimistic about the job report tomorrow. I mean, we did see ADP reported on Wednesday that 218,000 jobs were created in the private sector. And you know what I was optimistic about was that 84,000 of those jobs were in the small business and 92,000 were in the mid-sized business. So to me, that's a really positive sign, is to see some of that growth.
And ADP mid-size starts at 500 employees. Some people would even argue they could count all of them as small businesses.
That's right.
Let's use Joni's 250 number, Jim. 250,000 jobs. What does the market do?
Look, I think right now the market is going to, we're going to get the 5th month in a row of 200 plus. I'm going with 2.25, but I think the market is going to, move a little sideways and even feel a little heavy right now. Because again, I still believe that good news on the economy, and we're going to get good news tomorrow, is going to have people be a little cautious.
But what about wages? Anyone looking at wages? Because I actually think the wages, as far as the narrative for this week, it probably will matter more tomorrow than the actual jobs.
Well, I think a few days ago we would have said if wages go up, that's really good for the market. But we saw today people are concerned about wages going up. So I think the market's a bit torn. I think if wages go up, it will be positive. It will be good for stocks. I'm similar to Jim. I think 224 is what my guess is for tomorrow as well. So a little bit lower in Joni, but I think anywhere between 2.25 to 250 will be good for the market.
Good news for the economy does not mean good news for Wall Street. I'm on with Joni too. I think it's going to come in at 250. I think retailers are going to add a lot more of those jobs. I don't think the market's going to respond well.
I like what you're saying about retailers. I'm going with 280, and I think wages will be subdued. Watch tomorrow.